Welcome back to the part 2 of the presentation on Introduction to ABS, Fixed Income CFA Level 1 2021-2022. Now, in the last video, we talked about the basic elements of securitizations, starting with the need of securitization and the concept of securitization. We also discussed the structure, how the securitization structure is conceived of, and which are the different parties to it, what are the risk elements that are being covered in the securitization, and how the credit sensitive assets are transferred from the bank's balance sheet or the warehouse lender's balance sheet to that of a separate entity that is called bankruptcy remote SPV. We also discussed that how different risk and rewards are being redistributed from the cash flows that emanate from the borrowers to different pools of loans and advances. And we also discussed about the risk, how they are stacked up against each of those tranches. We discussed the securitization process in the form of the structured notes, and we also discussed the characteristics of different notes in terms of their types, classification, um, and what are the different asset classes under the structured notes, starting with MBS, that is mortgage-backed securities, and then other asset-backed securities in the form of auto loan, credit card, etc., etc. We talked about a very important subordination structure called the collateralized mortgage obligation, which is further divided into sequential pay, collateralized mortgage obligation, or sequential pay CMO as it is famously known. And there the second structure is the planned amortization tranches derived out of the planned amortization curve. Now we will discuss in details what is meant by the planned amortization curve in this part of the video. And I also demonstrated that how this entire structure that is being created, engineered, really is nothing but the redistribution of the original pass-through notes. That is, we actually do not create anything out of thin air. And we talked about how the immunization program work in terms of the pack tranches, and we discussed two risks, namely the contraction risk and the extension risk, both of them collectively called the prepayment risk. And we showed that how, if there are enough support tranches that are ready to absorb the two different kind of risks, that is the risk of contraction and the risk of extension, along with the risk of delinquency and default, how, if there a structure be conceived of, then how the pack collar is immune to the extent that the support tranches are able to provide the necessary security and the immunity. Now, let's start with something called as the asset class of the mortgage-backed security. As was discussed in the mortgage-backed security session, that the mortgage-backed securities are further divided into something called as the residential mortgage-backed security and the commercial mortgage-backed securities. So the residential mortgage-backed security again forms the largest asset class of the mortgage-backed securities. And we also talked about that the notes, the structured notes, are primarily of two types. One is the agency-backed structured notes, that is sponsored by the government entities, which require almost nil to negligible credit enhancement, and vis-a-vis the privately issued structured notes that required considerable credit enhancement. We must understand that credit enhancement is an integral part of a structured security because of the inherent risk of default. And because the borrowers may default, hence the investors pool need some sort of insurance, some sort of backup, and the credit enhancement stand guarantee to that. Credit enhancements exactly is created, exactly is introduced to fulfill that part of the cog. Now, let's further deep dive into the security level. So the mortgage-backed security, how the credit enhancement is being achieved. So it is achieved a couple of ways. One is at the asset level design itself. So if we talk about the CMO, I had explained in my previous video, if you have seen that video, that in CMO, really speaking, it is not a true subordination unless these junior tranches are so designed as to absorb any default losses. The so-called senior tranche and the junior tranche they actually complement each other in the sense that the senior tranche protects the junior tranche against any sort of contraction risk, and the junior tranche in return protects the senior tranche against any sort of extension risk. We had discussed that in length. So when you create a structure like this, the risks of contraction and extension do negate themselves to the extent of the face value covered in the structured note. The other aspect is that of subordination. And in case of subordination, the structure is a typical waterfall structure. And in this waterfall structure, the junior notes are supposed to protect the notes that sit above them, much like the balance sheet's liability side, where in the creditor, the senior rank creditors will have the first claim and the first right to the company's assets should there be a need of liquidation. And also, the senior claimant and the senior creditors are the one whose cash flow needs are first met. So, exactly in the same fashion, the subordinate structure protects the interest of the senior tranche, and the junior tranche provides the necessary protection to the extent of their face value. Now, in case of the the loan level protection that's there, the quality of loan will decide the quality of the pass-through securities that are engineered out of them, that are created out of them, synthesized out of them. So long as the borrower is a prime borrower, that is, he or she has a respectable FICO score or a CIBIL score. CIBIL score, for the viewers who are unaware of, is the equivalent of FICO score and is being practiced in India. So the borrowers who have a good FICO or a good CIBIL score, it is expected that when they borrow against their mortgage, they are least likely to default, which means that the quality of the borrower is of prime quality. In contrast to that, there are quality of borrowers who may not have a very respectable FICO or CIBIL score. Such borrowers are called the subprime borrowers. Now, the 2007-2008 financial crisis, part of the reason that why the crisis unfolded was because of the higher concentration of the subprime borrowers in the loan asset pool. So to the extent that the asset pool of a bank is comprised of good borrowers having respectable credit score, it is expected that the possibility of default will minimize. The other aspect is that how the cash flows are structured as far as the borrowers are concerned. Now, it could so happen that since the mortgage payment comprises of each month interest as well as the principal as well as the prepay, the last two put together are called the amortized principal. Now, the amortized principal again could be either a fully amortized principal, that is, every payment from the borrower's end will have some portion of the scheduled principal. Along with that, at the discretion of the borrower, he or she may decide to part pay some portion of the outstanding principal. Now, when such a thing happens, it again serves a couple of purposes. One is that it boosts confidence because the outstanding with every payment cycle reduces proportionately because of the amortized principal being paid back. And the second aspect is that the second characteristic is because now there's less amount of outstanding there in the market, so the absolute interest that the pool of investors would be enjoying would gradually diminish. That's the trade-off. So it's really up to the underwriter how he actually synthesizes different structured notes. A combination of prime and subprime notes are not unheard of. In fact, again, going back to the same example of 2008 financial crisis, the pool of assets that comprised of the borrowers and those notes that were rated AA, even triple B or triple B plus, these notes had considerable amount of these subprime loans. Now, these subprime loans are highly susceptible to default because of the nature of the borrower themselves. The other aspect that we need to understand, but nonetheless, this how the quality of borrower is also an important element of how risky the structured note that would emanate out of the whole structure be. So that's one. Second is the type of mortgage, whether it's a amortizing mortgage or a non-amortizing mortgage. Again, that would decide the type of structured note that will be created out of them. The third important aspect is the rate of interest and the structure of the rate of interest. Whether it's an adjustable rate mortgage, that means that it's closely tied with the floating rate note, or it's a fixed rate mortgage. Now, depending upon the type and quality of the borrower and the quality of loan, the floating rate note or the fixed rate loan could be either proved to be good or detrimental to the health of the structured notes themselves. So, in effect, you need to understand that the protection is being provided in two ways. One is the engineered assets have something called as a subordination structure, which we discussed. Second is the creation of the CMO notes, which have negating effect. This is at the structured note level, so the asset level design. The another aspect is that how the quality basically got to do with the quality of the asset pool itself. Higher the quality of the asset pool, lower the probability that this may default. In contrast to this, the main difference between a commercial mortgage-based securities and the residential mortgage-based securities is that in case of the residential mortgage-based securities, amortization is must, which comprises of the scheduled principal payment as well as the part payment of the prepayment. In case of a commercial CMBS security, the concept of prepayment does not exist. In fact, there is something called as the call protection period. The call protection period necessitates that the borrowers will not be able to pay any part of the principal back to the lender and hence to the structured notes holder up until a certain period of time, beyond which they will be entitled to pay partly some portion of their principal in a staggered manner. So this is one important difference between the residential mortgage-based securities and the commercial mortgage-based securities. So the residential mortgage-based security vis-a-vis the commercial mortgage-based securities, in this case, the loan is amortizing in nature. This is non-amortizing in nature. Second is that should the borrower so decide so as to pay off the loan nonetheless, at least a portion of it, then there is going to be a heavy penalty being levied in the CMBS structure. Now, this would mean that the borrower would have made a part payment before the call protection period could end. So the penalty is being collected either one of the four ways, something called as a hard penalty, wherein a fixed amount or a percentage of the outstanding amount is being paid off along with the principal that the borrower may want to retire. Second is something called as the yield maintenance charge. The yield maintenance charge would mean that the borrower, even before the borrower could make part payment, from the very first interest amount that the borrower has been paying, would have some portion of it being necessarily part into some free assets, some risk-free, high-quality assets. So this risk-free high-quality assets would be the one which would generate the similar amount of penalty interest should the borrower at a later date decide to make any part payment. There are a couple of more things that we need to understand that differentiate between the CMBS and the RMBS. And that is something called as the workout period and the default interest rate. Typically, in a CMBS structure as well, the risk of default is not mitigated because the risk of default is pertinent and relative to the borrower themselves. So the borrower could be an owner of a shopping mall or a housing complex or a commercial complex altogether, or it could be a hospital. So any of the commercial establishment, the borrower could be from them. So in case the borrower defaults, so a workout period is being considered wherein the entire loan is restructured. And in this process, if the original tenor was 15 years, it might so happen that at the first instance of default, the borrower and the lender may mutually decide, according to the terms set in the loan agreement, that the new tenor would be of 20 years. Of course, it comes along with the alternate rate of interest as well. So the leeway that is being provided because of the default that becomes imminent, the borrower may extend the loan tenor in order to protect his interest. That way, the borrower has an additional opportunity to make good of the loan when it becomes due. Within this workout period, the rate of interest, of course, is not the same as that of the original structure. Because of the default that the RMBS, because of the CMBS borrowers may pose, an additional penalty in the form of default interest is being levied. The fourth important aspect is that of the balloon risk, and that is being borne by the notes holder because of the non-amortizing nature of the security structure themselves. So there is a probability that the borrower at the end of the tenor may be making a lump sum balloon payment of the principal, or at least a considerable portion of it. And at that point in time, it's the notes holder that will be faced with this counterparty risk that the borrower may default, which is also called as the balloon risk. So the balloon risk is a typical of when the notes are supposed to be retired, at least partially, beyond the call protection period or very near at the end of the tenor of themselves. Now, the same level of protection exists in CMBS structure as that of the RMBS structure. That is, there is a redesigning that happens at the asset level, and at the loan level, the concept is, as I have mentioned, that high quality loan with low loan LTV would mean that this becomes a high quality loan. So lower the LTV is preferable, all else equal. Secondly, the tenor themselves. So all else equal, a shorter tenor would, of course, remove the uncertainty and the risk associated with it. So a loan level of 30 years may not be desirable as compared to a loan tenor of 15 years. Of course, as we have spent considerable amount of time discussing the amortizing principle vis-a-vis the non-amortizing principle, which is the key differential point between the RMBS security and that of the CMBS security. We discussed about the concept of the yield maintenance charge. Another aspect of this is that the CMBS securities typically is a non-recourse security. What is meant by non-recourse? In case of a residential mortgage-backed security, the lender, and in this case the notes holder, may have some recourse in the sense that they would not only get hold of the prime mortgage itself, this is the underlying property, but may go to the extent of suing the borrower in case the mortgage, the underlying property that is insufficient to meet the principal amount that has been lent to the borrower. No such establishment exists, no such arrangement exists in case of a CMBS and a CMBS structure. Another aspect is that the CMBS structure, if it is a sequential mortgage pay, it's a sequential pay CMO structure, then in that case, there are certain metrics that are being followed after the senior tranches are being paid. And that is the establishment of a desirable DSCR ratio. The DSCR ratio, that is the debt service coverage ratio, is nothing but the net operating income from the underlying property themselves. In case of a real estate, in case of the CMBS type securities, the underlying property, the net operating income is less of the revenue minus the operation expenses minus the accumulated depreciation or the depreciation for the year. In other sense, it is very similar to the earnings before interest and taxation in our normal course of things. So the DSCR is nothing but the net operating income divided by the interest payment due and the principal that would be due. Remember, the principal is only due after the call protection period is over. So typically, whenever the DSCR has to meet certain insolvency norm, certain liquidity aspect has to be fulfilled, certain criterion will have to be met, and that would necessitate the DSCR attaining a minimum score before the junior tranches could be paid. Such is the structure of a CMBS waterfall. The other asset classes that we ought to know, and this is fairly simple as far as your level 1 syllabus is concerned, and I'll just touch base upon them because they are really not much beyond this particular slide. So asset loan, auto loan, the other are basically the auto loan, personal loan, and the credit cards receivable. Now in this, the primary difference between the auto loan and the rest of the loans are that the auto loan typically is it's basically an amortized, it could be an amortizing type. That means that to this extent, the auto loan borrower would not only be paying the interest, but this scheduled principal as well. But unlike mortgage security, the auto loan borrower may not be paying the part principal. So the prepayment risk is, in case of an auto loan, does not really that significant as that of the underlying property in case of a residential mortgage. Now, in case of the ABS security, the lender, in this case the notes holder, has a full recourse. That is, that they would not only be, in case of a default by the borrower, they would not only be in a position to seize the vehicle, but also in case the vehicle has met with an accident or has undergone a damage which is beyond repair, which is classified under the total loss under the laws of insurance. All the proceeds from the insurance may accrue to the notes holder. So it's not only the underlying property, underlying car, or the underlying auto under consideration, but also the insurance proceed as well that accrue to the notes holder in case there is a total loss. Now this is a typicality of the auto loan ABS. So as far as your exams are concerned, I don't think that they're going to ask you anything beyond the difference between an auto loan ABS and that of the non-auto loan ABS other than the MBS securities. And they're going to ask about the extent of the recourse and it has a full recourse, and that's it. And whether an auto loan could be amortizing in nature or a non-amortizing in nature. So these are the three differences only that you just need to understand, the three attributes. As before with the MBS type of security, it could be a classic waterfall structure of both the CMO type as well as the um, structured subordination. In tranche, structured subordination could be further divided into the credit tranching as well as the time tranching. We have discussed about both credit tranching and time tranching at length in our previous slides. Now, as opposed to the auto ABS, the other asset-backed securities are basically uncovered, or they really do not have any hard asset to back up. And those are the credit card receivables, the personal loan, or the student loans. So we must understand here that against the credit card receivables or the personal loan or a student loan, there is really speaking no collateral at the asset level. Okay, there's no collateral at the asset level, which means that there's a considerable risk that's being borne by the notes holder, because if there be a default, there's really nothing much the um, note holder could fall back to, because there are no hard assets. The note holders can't possibly be suing a student and seize his degree in case the student fails to make the payment. I'm not sure if the student in consideration is a med student, and whether the med student, if he fails, if he or she has failed to pay his student loan fees, student loan, if he has failed, whether his license can be annulled, or his license could be impounded. That I'm not sure of. But other than that, really speaking, the notes holder could do nothing by seizing the degree of a student. So that's the primary difference. Now, in case of the other assets, we need to understand a few characteristics. First is that there is a considerable lockup period. So what is a lockup period? So a lockup period would mean that the credit card borrower or the personal loan borrower, they are allowed to make the payment which comprises of the interest and the principal. However, the principal will not be passed on to the notes holder till such a lockup period is there. Within the lockup period, if there is any receipt of principal, those principals will be reinvested into the outstanding of another set of credit card loans. The same thing goes with a personal loan or a student loan. Sometimes the asset classes are diversified and mixed all put together, so it might so happen that the notes emanating out of these unsecured products may comprise of 50% credit card receivable, 25% personal loan, and another 20 or 25% student loan. It's quite possible because the nature of these assets are pretty similar in nature. So coming back to the point that I was just making, that the lockup period is there, the principal received from the credit card borrowers or the other unsecured loan borrowers are reinvested in similar kind of assets. However, beyond the lockup period, the notes holder must be prepared to receive the amortized principal. Also, they should be ready to receive the balloon pay of their principal. Now, because of this balloon pay could be received at one go, there's a considerable default risk, counterparty default risk that does exist. And at the same time, should they receive a lump sum of their principal, the question still remains that will the investor have the opportunity to reinvest the proceeds that they have just gotten from in a similar kind of securities. So this is called as the balloon risk. So balloon risk, as the text might have explained, it only limits to the default risk, but it's not so. The balloon risk also extends to the reinvestment risk because of the lump sum principal being received at one go. Now, In the context, there is something called as the early amortization or the accelerated amortization. What do we mean by that? Now, at every given point in time, the health of the underlying securities forming these notes, unsecured notes that are, the health status is are assessed by the underwriting manager through various diagnostic tools, of one of which could be the solvency ratio that I just talked about, like DSCR and stuff. So there are other metrics as well which are deployed. And if the health is found to be not okay, then at the discretion of the trust manager or the underwriter, there could be an early call, early amortization, which means an early retirement of the principal. So that is being done in order to protect the interests of the notes holder. So the early amortization is a contingent action and not a norm. The last piece of this whole asset class is that of the CDO, or the collateralized debt obligation. A collateralized debt obligation is a complex set of securities. The structure necessitates that there be a CDO manager, and the only motive of the CDO manager is to earn something called as arbitrage spread. Now, in the contest, the word arbitrage is a little bit of a misnomer, but we'll see shortly why it is called so. So before that, let's understand the structure of a CDO. Typically, a CDO, the collateral of the CDO, the assets backing the CDO, would be nothing but another set of structured notes, which could extend from being a simple pass-through notes to other complex securities in the form of CMO or other loans, or even another set of CDO. The objective is to diversify the pool of assets so that the risks, the individual risks pertaining to any particular asset class, is suitably spread, and ultimately the notes holder are not made to suffer. However, this entire structure does come at a particular cost. And as I said before, here the motivation, such a structure is being created by a motivation of the CDO manager. More often than not, the CDO manager would find a swap counterparty. And how a swap counterparty comes into a picture, we will understand that in a little while. But let's just follow this diagram and how it works. Remember, at every given point in time, the solvency checks and other health diagnostics are performed even before the junior tranches could be paid. So let's see a quick look at how a CDO structure works. To begin with, these are the pool of diverse loans, and that could range from MBS to other pass-through securities, which form the basic collaterals and the basic assets backing the CDOs. The CDO manager repackages these notes and then redistributes them according to the risk appetite of different classes of investors into senior secured notes, senior semi-secured note holder, and the equity tranche. In this equity tranche, the CDO manager also retains some stake so that the confidence to the note holders is retained. They do understand that the riskiest piece is also being owned partially, if not fully, by the manager who is selling these notes to them. So this boosts kind of confidence to them. But in this case, the senior secured notes holder may have been promised a fixed rate of interest. Now, while the underlying mortgage, the underlying pool of assets, collectively in a weighted manner may be bearing notes having interest that are being driven through floating rate. So how does the CDO manager solve this puzzle? How does the CDO manager generate a fixed rate income for the senior note holders and even the senior semi-secured notes holder, originating the origination of which is floating rate note? And this is where a structural engineering comes into picture. The CDO manager then goes and searches for something called as a swap counterparty. The swap counterparty is basically a bank or a high-end dealer who is ready to provide you the fixed rate of interest against the notional principal that is being exchanged with the CDO manager. The swap counterparty's motivation is that he believes that the floating interest rate in the near term or in the long term or in the medium term, as the case may be for the tenor, might increase. So with this motivation, the swap counterparty agrees to enter into the swap agreement, promising to pay a fixed rate of interest against receipt of floating rate of interest. The CDO manager in turn has no objective, no view as regards the interest rate, because his interest lies in this equity tranche and not with the floating rate note or the fixed rate notes. So we will see how it happens in case the cash flows, these cash flows, if it is floating rate nature, are being received at the CDO manager's end, and the same floating rate notes are redistributed to the swap counterparty against a promise of fixed rate interest pay. Now, this fixed rate interest pay is then received at the CDO manager's end and is being redistributed to the senior secured notes holder, following which the senior semi-secured notes holder will be getting their dues. The remaining of the cash flows are directly attributed or directly paid to the tranche, equity tranche, part or full of which is being owned by the CDO manager themselves. So this is the structure of how a CDO manager makes an arbitrage spread out of this. The reason why it is called an arbitrage is because the CDO manager is indifferent to the extent of the face value between the floating rate of interest and the fixed rate of interest. Really speaking, the CDO manager owns none, so long as there is not a question of default. So either the swap from the swap's counterparty's end or from the original borrower's end. So the CDO manager really has got no stake in the game other than the small equity that the CDO manager is holding in this whole structure. Often the leverage ratio could be in excess of 1:10 or even 1:20. So the risk is that if this structure fails, because of this thin leverage, the structure could collapse very easily should there be considerable default. But that is exactly what entices the senior note holders and the semi-senior note holders, because against this they earn a considerable amount of high yield, and that high yield is also in the form of a fixed interest. In the beginning of this presentation, in the preceding presentation, we talked something called as the prepayment. Now we are going to discuss about two more concepts associated with this prepayment called the SMM and the CPR. To begin with, the SMM stands for single month mortality. SMM stands for single month mortality and is a measure of the part prepayment that the structure may expect to receive every month. And when this single month mortality or SMM is being annualized, they are called the conditional prepayment rate or CPR. All right. So before that, let's take again a quick look at how a CMO is formed. We already discussed about how the CMO is structured. The first to begin with is a sequential pay CMO. Second is CMO with a pack tranche. We discussed about it as well. And the third is, which we're going to discuss now, is creating a structure having two different sort of interest rates being put together in that. One is called the floater and another is called as the inverse floater, so that the net effect is negated completely and the structure is unaffected by it. All right. So what is meant by prepayment? So typically in an MBS security, the borrowers are entitled to pay back their mortgages without suffering any penalty whatsoever in most of the cases. And more often than not, most of the mortgage pool would experience some sort of prepay every month. So when the prepayment happens, the typical problem is that the structure is going to face something called as the contraction risk. Mind you, this contraction risk is regardless of the structure themselves, because the senior structure is only going to be protected by the junior tranches to the extent of their face value. Beyond the face value, it is called a busted tranche or a busted pack. Beyond those face values, the contraction risk would ultimately accrue to the senior note holders as well. So when somebody actually participates in this economic program, it is perfunctory that one should be aware of the risk associated with the structure themselves. And as mentioned before, the prepayment is an inevitable phenomenon, is an inevitable truth. So the only thing is that one must understand that what is the extent of prepay that the note structure could estimate over the tenor. Now, anecdotally, it has been observed and mostly confined in the US market, taking reference from the US market, that typically the prepayment happens at the rate of 0.2% per month of the outstanding principal. Now, mind you, this is a historic data representation only, but nonetheless it serves our purpose because a prepayment speed associated as or termed as 100 PSA is attached to the prepayment rate of 0.2% and forms thus the datum level. Datum level to what? Datum level to estimate the prepayment rate or what the notes holder in the structured securities could expect over the tenor of their holding. Now, also what is being seen is early in the mortgage, the prepayment is at the rate of 0.2% and it rises and it keeps on rising until the month 30. And at the month 30, the prepayment somewhat stabilizes, it does not increase much. And by that time, the prepayment rate remains constant for the rest of the tenor. Excuse me. Now, whatever I'm talking to you, these have been gleaned out practically from the market. Nonetheless, they help us form the initial submission, an initial idea of how the prepayment structure affects, prepayment speed affects the structured security market. So we designate the prepayment rate of 0.2% per month up to 30 months as 100 PSA. Needless mentioning, if the prepayment speed is more than that, then the PSA would also be termed as a higher PSA. So typically, I'm quoting a number. If suppose the prepayment speed is instead of 0.2% per month becomes, let's say, 0.25% per month, nonetheless, it has been observed that as the securities age in the pool beyond the month 30, the propensity to prepay gradually comes down, and it remains, it does not vanish altogether. Please understand what is being said here. It never is said that the prepayment ceases to exist. All that it says is that it does not accelerate any further. So it might so happen that we multiply 0.2 by 30. So out here from the 31st month of the outstanding principal of the remaining portion of the mortgage, the prepayment would happen but would remain constant at the rate of 6% for the rest of the tenor. Similarly, if the prepayment speed is 0.25%, beyond the month 30, the prepayment speed will be 7.5%. Now, this 7.5% is being termed as 150 PSA against this 100 PSA of 6%. Similarly, if the prepayment speed in the pool is less than 0.22%, let's say it is about 0.15%. So by the time it is month 30, the prepayment speed would have stabilized somewhere around 4.5% and would remain constant for the rest of the tenor of the outstanding principal in the pool. But that term is being designated as PSA of 75. This is the structure which you need to understand. This is exactly how it happens. Now, what does this mean? If the prepay speed remains at PSA 100, the structured notes could be so conceived that it becomes perfectly immune to any sort of contraction or extension risk, because that the prepay speed is already accounted for in this structure, so there is no threat of any additional prepay happening in this structure. On the other hand, if there has been accelerated prepayment, the structure is exposed to contraction risk. And if the prepay speed is less than the datum level of 100, the structure is exposed to extension risk. Now, within the credit tranche, how the structure is being further subdivided, I'll explain it through the diagram out here. So for instance, at 100 PSA, tranche A is supposed to have 7 years of life. Tranche B is supposed to have 9 years of life. Typically, this is a waterfall structure that we have already discussed many a times in the preceding slides. Tranche C12 and tranche and the collateral backing them all put together have a life of 10 years. Now, if the prepay speed is more, then but obvious we understand that the life of this pool would shorten accordingly. So the tranche A will not have an average life of 7 years, but instead of average, it may have 5 or 6 years. Tranche B typically may then have 7 or 8 years, and tranche C will have only 10 years. On the other hand, the prepay speed, if it is lower than expected, the tranche A gets elongated and has a life of now 9 years, tranche B 10 years, and tranche C 14 years. All right. So let's work out a math out here, and this will, I believe, clear any of the doubts that you might be having. So I have taken a classic CMO, a pack CMO with a combination of sequential pay as well as the support tranche. All right, so first we will define the pack collar. As we have known before, that the pack collar is the one that is immune, or that is supposed to remain immune against any sort of prepayment threat. So in this example, the pack 1, pack 2, pack 3, there are 3 tranches. And as long as the base prepayment speed remains between 75 PSA to 200 PSA, the average expected life of all these 3 pack tranches will remain intact. So for example, if pack 1 was supposed to have a life of, let's say, 7 years, pack 2 a life of 9 years, and pack 3 a life of 10 years, so long as the prepay speed, each other thing remaining constant, so long as the prepayment speed remains within 75 to 200 PSA, they will remain protected, they will remain immune to this. They will still have a life of 7 years, 9 years, and 10 years respectively. But if the prepay speed is breached beyond that, either on the plus side or on the negative side, then the life contained here could not be guaranteed. So where does the question out here is, where does this protection comes from? So we will explain out here where the protection comes from. So, and above this, there are a couple of tranches being shown as tranche A and tranche B. However, we must understand that both tranche A, tranche B, tranche Y, tranche Z, and the tranche equity, all of them are subordinate to this pack tranches. In this pack tranche as well, there is an extra bit of security being provided to the pack 1 that sits above pack 2 and pack 3. So the chance that pack 1 will be busted, or pack 1 will not have its desired life of 7 years with the promised cash flow, that's very minimal, because there are three different levels of protection being provided to Pack 1. The protection against a contraction comes from tranche A and tranche B. The protection against extension comes from tranche Y, Z, and the equity, tranche Y and tranche Z. Any default also is directly attributed to the equity tranche. And within this pack collar themselves, it's a sequential pay CMO that would mean that the pack, if there be any sort of threat of default or if there's any sort of accelerated payment, so in that case, pack 2 and pack 3 will take the hit first before it can reach pack 1. So that is how pack 1 enjoys the ultimate protection at the structural level, both from the tranches that are subordinate to it, as well as within the pack collar, the sub tranches that are subordinate to it. Coming back to the subordinate tranches, the tranche A and tranche B are so designed so as to protect this pack collar against any sort of contraction risk. And as we know, that contraction happens when the prepay speed exceeds beyond a threshold level. So in this example, as we have said before, that if this prepay speed is, let's say, this prepay speed is 250 PSA, or let's say 300 PSA. So that would mean that there is a severe threat of contraction. However, in such an instance, the tranches A and B, to the extent of their face value, will absorb the additional part payment or the amortized principal in their fold and thereby going bust, thereby providing the requisite support. However, this support is not endless and not without a limit. As I said before, that it can only protect up to the extent of its schedule, to the extent of its face value. So in case, let's say, the prepay speed is abnormally high at, let's say, 400 PSA, the tranches would become completely exposed because they will immediately bust beyond a certain point in time, and then would expose this underbelly of the pack collar. However, in that situation as well, these two tranches would have sacrificed themselves and would have done their job to the extent possible. So this is what the tranche A and B are supposed to do against a contraction risk. As opposed to that, if the prepay speed is, let's say, 50 PSA or let's say 40 PSA, in such a situation, the extension risk is being borne by tranche Y and tranche Z. And the same principle follows. They will only be able to protect the pack collar to the extent of their face value. And to the extent that these avalanche of lower rate, avalanche of the slow and tardy prepayment, beyond their face value, this underbelly of pack collar is exposed to the extension risk as well. So in our example out here, we have assumed the pack tranche as 800 million. So this collectively, the face value of pack 1, 2, and 3 is 800 million. Protecting that is the support tranche against contraction risk, the face value of which is 350 million. And to protect against the extension risk are the junior tranches amounting to another 350 million. So you could see that this pack collar is almost protected to 90% of its face value. How is it possible? We have 350 million protection for the contraction, 350 million protection for the extension. So total protection being provided is to the tune of $700 million face value, and the pack color is close to $800 million. So the proportion comes to roughly close to about 90%, 89.8%. That's a huge amount of protection. So it's very unlikely the pack one, even under extreme circumstance, would ever be exposed to any sort of risk whatsoever because of the long level and deep level of protection being there. All right. Now, against the risk protection that does not come free of cost, the support tranches enjoy the higher yield, typically much higher than what the pack caller would be entitled to. And that is but natural. Now let's work out a couple of maths in order to glean out the whole concept and make it more lucid. I know it's been pretty theoretical in nature so far, but as I work through the problem, I'm sure that it is going to be much easier to relate to. So we take this example of a simple amortization schedule. The bank under consideration is a fictitious bank called Bella Fair Generali, and there is a loan amount of close to um, $1 million loan has been sanctioned, and the tenor is of 10 years, 10 years with the rate of interest, annual rate of interest being that of 8% and is assumed to remain constant. There's a monthly payment that happens, so the total number of payments is 120, and here we're talking about the actual first 11 payments that has happened with the actual date being given. Watch as the first payment is being made on 1st of January 2022. So in this case, starting with the beginning principal amount of $10 million, the scheduled payment of this has got typically an interest component as well as the principal component. The cumulative interest and the principal that is being paid are being recorded here. So by the end of the 10th month, the total amount of interest that's being paid is close to $664,997. Against a total principal payment for the first 10 installments comes out again roughly to be about 60,000. So I'm just rounding it up, and 60,000 of principal. So the first 10 payments equated monthly installments. The first 10 payments comprises of 60,000 of principal being repaid, as well as 65,000 worth of interest being also paid. Now to this, we will incorporate a couple of more assumptions. One is the scheduled prepayment of 0.2% per month, which is designated at 100 PSA. And second is the servicing fees. And let's see what happens after that. So typically, if there be a 0.2% payment, and that 0.2% payment is of the outstanding principal of the beginning of the month, so you could see that the first month does not have any, of course it cannot have any prepayment, but the second one, $1,965 is being made as part of prepayment. How did we arrive at it? So we simply took 0.2% of the outstanding $987,000. This is the beginning principal. So we took, see, the 2% of this comes out to be 1,965. So the total principal that has been paid comprises of the scheduled principal, as well as the interests and the part payment that has happened, which is $14,097. Now, we have also assumed 0.08% of servicing fees. The servicing fees, as we have discussed, are typically the administrative fees of reminding the customers, ensuring the customer pays on time, following up with payment, and even sometimes going physically to collect payment. Of course, in this age of digital era, all those things may sound pretty fictitious, but not until very recently, these were pretty much reality. Nonetheless, a bank would be charging its servicing fees, and within that servicing fees, of course, there lies some portion of the profit as well. So this is the servicing fees. Now, what accrues to the notes holder who have funded this loan is a net of all of them. So typically, the total payment has been 12,133. That's the first month. The servicing fee has been $800. So we deduct $800 from this. This is what is available to all the tranche holders. So this is how we have typically worked out all the 10 payments. Now this, if it were a pass-through security, and here comes the whole puzzle. If it is a pass-through security, so this 11,333, this amount will be equitably distributed to the pass-through security notes holders. That means there is just no preference to any particular tranche holder, but to the extent of their investments, they would be collecting a portion of these cash flow proceeds. But since we have evolved from the pass-through securities and advanced to more complex securities, more engineered sort of securities, the underwriter would then redistribute those repackaged notes to different tranches, which we have discussed at length before. So this is the mathematics of how things happen. Credit enhancements. As mentioned before, that credit enhancements is an integral tool to the non-conforming private level MBS securities. Now, there are a couple of ways that these credit enhancements could be achieved. One is the internal, second is the external. But before that, we need to understand that, is this mandatory? The answer is yes. This has to happen for various reasons, because unless you provide the credit enhancements, the rating agencies will not be comfortable rating your security or the repackaged notes which you want to distribute and sell to the pool of investors. So from a selling point of view as well, to secure a higher rating, it is customary that you secure your credit sensitive assets by means of credit enhancement, whether it be internal or external. From the investors pool side, there is an additional level of comfort if a security is rated AA and yet is yielding 7% as opposed to a AAA security or a similar government security which will only be yielding 2% or 3%. Now, it becomes almost too good to refuse. Hence, from this perspective, and to boost the rating agency's confidence, enhancement is a mandatory thing for non-conforming securities. The agency-backed conforming securities do not typically require any sort of credit enhancements. All right. So there are three ways of securing this. First, we'll start with the internal credit enhancements, subordination, over-collateralization, and the reserve cash account. We have discussed in length the subordination structure. We are not going to talk about it. Let's dive directly to the over-collateralization. All that it means is, if the underlying mortgages is, let's say, $1,000 million worth of property, the structured notes will only be created up to the extent of $800 million. The additional $200 million will be kept as buffer in case there is a run on the structure. So that's called your over collateralization. The reserve cash account, on the other hand, is nothing but a portion of the proceeds being kept as reserve in order to meet any liquidity demand or in order to meet any exigency, including that of default. So mechanism wise, if the underlying mortgages in a weighted basis carry a coupon of, let's say, 9%, then After removing the 0.5% or let's say 0.5% of the servicing fees, the rest 8.5% is not redistributed directly to the pool of investors. Out of this 8.25%, 1.5% of the cash proceeds, 1.5% of the cash proceeds is being parked in a safe account, an interest-bearing safe account, and the rest 7% is then redistributed back to the tranche securities. So by means of these three, the the, the credit and the credibility of the structure is retained. On the other hand, the external credit enhancements typically would mean that there are external parties of this. We will first start with something called as the letter of credit. So the letter of credit is nothing but to the extent, and this is more typical of the commercial mortgage-backed securities, or let's say the other asset-backed securities other than the mortgages. Okay, so in this case, the issuer of the security is also being scrutinized for the line of credit that it might already have. So it could have already some working relationship with some of the financiers or bank through which it can immediately secure a line of credit. So why this is required? Again, if there is a default or delinquency, the secured line of credit could immediately act as a conduit and ready reserve to provide and meet the imminent cash flow demand. Similar is the arrangement of letter of credit. Similar is the arrangement with the letter of credit as well. The only difference between these two is the letter of credit with the existing financier, you may or may not be required to have a working relationship. However, with a secured line of credit, the lender who is going to stand guarantee to you will definitely want a working relationship. Cash collateral is nothing but basically what the cash in total is retained in the balance sheet of the issuer. And last but not the least are the external financial guarantors. So we have in the form of monoline insurers who are ready to insure the credit sensitive assets against a certain premium. Needless mentioning, these premiums are quite exotic in nature. And then we have the credit linked derivatives, those exotic derivative contracts in the form of CDS and CLNs. We have discussed this in our preceding chapter. By means of these two, the credit enhancements are being provided to the structured notes so that the investors have due confidence. Nonetheless, it is advised that the investors do their own due diligence before subscribing to any particular issue. As it said, caveat emptor. Okay, so now we work out a problem. James Rodriguez has recently been hired by Agnelli Alpha Investments. Agnelli is a mid-sized bonds underwriting firm. James has been tasked with creating three tranche structure to a 500 million face value pass-through securities with the following details. The remaining life of the pass-through security is 11 years. The pass-through notes carry a coupon of 10%. Tranche A will have a face value of 250 million. Tranche B, 150 million. The tranche A is scheduled to be exhausted in 7 years, while tranche B in 8 years. The proposed coupons for tranches are 8% and 9% respectively. What are the face value, life, and coupon for tranche C? So let's write down the problem as it occurs. So to begin with, the origination point is that of pass-through securities, because from here the structured notes of belonging to tranche A, tranche B, and tranche C is created. So the details are the face value of the pass-through securities is $500 million. The remaining life of this pass-through securities is 11 years. The coupon that it carries is to the tune of 10%. And of course, tranche A has been said to have a face value $250, tranche, and then this also has a life of 7 years, and the regular coupon that accrues to tranche A is 8%. Similarly, tranche B has 150 million of face value with a remaining life of 8 years and a coupon of 9. We have to find out the face value of tranche C, the life of tranche C, and also what is the coupon of tranche C. Okay, so to begin with, the way we will be approaching this is, since these three have originated from this pass-through, so we could say that the weight of the pass-through securities is definitely 100%, and the weight of tranche A security is 250 divided by the 500 face value, because these have been created from this. So the weight of tranche A is 50%. The weight of tranche B is 30%, which necessitates the weight of tranche C would be 20%. 20% would mean this becomes 100 million. You do the math because it's that easy. So from here, the first answer that we got is that the face value of tranche C is 100. Watch how this 250 plus 150 plus 100 becomes $500 million. Now, we have to find out the life of tranche C. Again, this should be fairly easy. All that we have to do is to calculate out here the total life of this tranche security obviously cannot exceed that of the pass-through securities from where it has been originated. So typically we could say that 11, that is the whole life of the security, is equal to 50%, because that's the weight of the tranche A. So in tranche A's coupon has been set for 7 years, so it's 50% of 7 years plus 30% of 8 years, plus this, obviously we know this is 20% of the total face value, and the life of tranche C. So if you solve the math, so this would come out to be, let's just do the math, it's pretty simple. This is 3.5 plus 2.4. In fact, we need not even do this calculation at all, because we have to find out this, since we have already got the 3.5 plus 2.4. This would mean that this portion is equal to 11 minus 5.9. How did we arrive at 5.9? Well, that's simple. 11 minus 3.5 minus 2.4 comes to 5.1. I'm sorry, so this becomes 5.1. So we have 20% of life of the tranche as 5.1 year, which means that the life of the tranche securities is 5.1 divided by 20%. So the life of the tranche security is now 5.1 divided by 0.2, which is 25.5 years. So we got the second answer. This is 25.5 years. Again, we must understand that we did not create anything out of thin air. This is the weighted, this is how the structure would work. So long after even this pass-through securities would have ceased to exist, the tranche security at tranche C would still be enjoying their elongated period of interest coupons. But of course, in a subordinated waterfall structure, this becomes also the first piece to absorb any sort of loss. We know that. And now comes the last part of the question. We have to find out the coupon that will be paid to tranche C. Well, again, that should be fairly simple. All that we have to do is, again, calculate the weighted average coupon and equate that with the pass-through securities from where it has been originated. So we could write that 10, which is the pass-through security, is equal to 50%, that is the weight of the tranche A, and the coupon being paid is 8%, plus 30% of the coupon being paid is 9%, plus 20% of the coupon being paid is tranche C. So if we solve this math again, this again becomes fairly easy, because all that we have to do is to minus 4 minus 2.7, 3.3. So this is 16.5%. So as before, we did not create anything out of thin air. We just redistributed the cash flows in such a manner that this is what it is. Please understand that this has been simplified from the level one's perspective, but there are a lot of other complexities. There are a lot of other factors that go into building a structured node. And as mentioned before, that against this elongated period of heightened interest, heightened coupons that the tranche investors would be receiving, they also buy in the trade-off is the default risk or any sort of other risks as the structure may define that will first hit the tranche C. We take another example, and I think this should again elucidate the whole concept much better. So here we have 3 tranches, and all put together the face value of this tranche all put together is 750, 400, 200, 100, 750. The life has also been mentioned here as the 7 years for tranche A, tranche B 8 years, tranche C 10 years. The coupon has been mentioned as 6%, 8%, and 10%, and the ratings have been mentioned, with the underlying pass-through securities having a face value of 1,000 and a pass-through coupon of 10. Now remember, this is a hybrid structure in the sense that the entire structure comprises of $700 worth of fixed income securities, and the last piece of the structure is an equity tranche. More often than not, this is how a CDO manager would operate, or any other structured security notes holder would operate, wherein the investment banker who would have underwritten these notes would typically own this portion of the structure. And in this process, this becomes also a very highly leveraged structure. But we would see, we have already discussed the risk and rewards. We would see in number terms how they stack up against all odds. There are some additional notes that has been mentioned, and that is that mandatorily $50 will have to be kept in interest-bearing account at the rate of 10%. The structure is a perfect waterfall, which means that the tranche A would enjoy the highest level of protection, followed by tranche B. A monoline insurer is ready to provide a CDS for tranche B against a premium of 0.5% as last resort. Now we have to answer the following questions under the given circumstances. Under normal circumstances, what should accrue to the equity tranche? Now this should be fairly easy to calculate, because here the payment is to the tune of $70, right? How is it? Because the underlying pass-through securities having a face value worth of 1,000 carries a coupon of 7%, which turns out to be $70. So this $70 will be redistributed according to the face values out here. So tranche A would be getting $24. Tranche B would be receiving $16, and tranche C would be receiving $10, thus totaling $50. So the remaining portion of $20 would accrue to this equity tranche holder. Now, mind you, the yield to this equity tranche holder is excessively high, to the tune of 40%. But that is exactly the motivation that why a CDO manager in the first place came out with this sort of engineered structure. So we answered the first question. Then under the normal circumstances, the equity tranche will receive $40, will receive $20 against an investment of $50. The second question it talks about is that there has been a default to the tune of $20. How much the tranches would receive respectively? Now, in this case, let's understand what has happened. Since this structure is such that 1,000 against $1,000, the entire securitization process is only to the tune of $750. That means there is a cash reserve, cash collateral reserve is to the tune of $250. So if there be, which is called as the over collateralization, which can be treated as over collateralization. Now, depending upon the bond indenture, how the treatment would be in case of a default. If we assume that the over collateralized account will suffer the first piece of loss, then this $20 loss will be first attributed to this over collateralized account. And if it be so, then the tranches would keep on receiving their scheduled interest and principal payment and the scheduled cash flows as has been devised earlier. So to answer question B, even if there is a loss of $20, the tranches would keep on receiving their same cash flow for the next year. The third question talks about if the tranche B has been underperforming, resulting in a downgrading from BBB to B minus. It is expected that because of this downgrading, the yield would notch to 12%. Will the CDS be triggered? If yes, then what will be the compensation granted? Now let's understand that out here what has happened is, if this rating was double from BB, it did have been downgraded to B minus, and because of which the asking yield is 12% instead of 8%. So 12% of 200 is 24. That would mean that the yield that the tranche B would have to shell out an additional $8. So to meet up this request of 12%, because 12% of 200 is 24, it was yielding $16. Now because of this downgrading, it has to shell out another $8. Now, will the structure be in a position to meet this cash flow? The answer is yes. And this $8 can come from various sources. Again, it depends upon how the structure and how the bond initiature has been put up in the first place. If it is so that the over collateralized account is being first called into play if there is a run on the structure, then from the coffer of 250 odd dollar, this additional $8 can be met. That is alternate number one. Alternate number two, again, as I said before, that it will depend upon how the structure is being, how the covenant is being structured. What is mentioned in the bond covenants, how the waterfall, what is the sequential and the preferential treatment would be should there be a credit event. Second is that if the over collateralized account is not to be touched because technically there has not been a default but a credit downgrade which necessitated additional cash flow, so that can be met from this reserve account as well, which hitherto was enjoying an interest of 10%. So it could be so that from this cash reserve account of $50, which was enjoying 10%, which means $5. So $5 could come from this amount, from this account, and $3 could come from over collateralized account, which already had $250 coffer in it. So it could be a mix and match of both as well. So that could be second alternate. The third alternate could be that since there is a monoline insurer which is ready to provide the additional yield because of this credit event, so the monoline insurer will be meeting this exigency and will be providing this $80 altogether. Of course, this 0.5% premium is still being paid regardless of the credit event takes place or not. So the insurer backs up, this becomes the third alternate. There is a fourth alternate, and that comes from the structure itself. And that is, in case this $8 has to be met, the trancee may sacrifice its entire 10% of $100, that is $10, and would only settle for $2, thus providing the $8 additional that is required to meet up the credit event. Or the fourth alternate could be, so within this, for the trancee suffering this, undergoing this credit loss, as part of this subordinated structure, again it could be so that the equity tranche foregoes its cash proceeds, which is more often than not is going to happen. So the equity tranche, instead of it receiving $20, will settle for $12 only, and thereby meeting this shortfall of $8 here. So this is the fifth but the most preferred route of how this shortfall will be met. And I hope through this example the entire learning have been gleaned out, and student candidates must have had a good session in understanding the underlying concepts. And as before, if you have anything to ask whatsoever, feel free to contact me at my email ID, that is newavatar190@gmail.com. Thank you very much.